So how in the world do you put a price on something that has no profits, no dividends, and, well, no physical form? That right there is the multi-trillion-dollar puzzle that is Bitcoin, and today we're going to unpack the different ways people try to solve it.
You know, if you ask someone from the world of traditional finance, the answer you'll probably get is pretty simple. You can't. Because Bitcoin doesn't generate any cash flow, it just doesn't fit into any of the standard models. And that leads a lot of people to just throw up their hands and say it has no intrinsic value at all. But as we're about to see, that conclusion might be missing the bigger picture. So here's our game plan. First, we'll dive right into that valuation puzzle and see why the old financial tools just don't cut it. Then, we're going to build a whole new foundation from the ground up using 3 core pillars. From there, we'll check out 4 different models people use to try and put a number on this thing before we land on the big idea that maybe, just maybe, Bitcoin is a completely new kind of asset.
Okay, so this brings us right to the heart of the problem. Trying to value Bitcoin with the same tools you'd use for stocks or bonds, it's kind of like trying to measure the temperature with a ruler. The instruments themselves are just fundamentally wrong for the job.
And here's where that disconnect really happens. See, traditional assets are valued based on the cash they produce. A stock has company earnings. A bond pays you interest. Real estate gets you rent. Bitcoin? It does none of that. There's no CEO, there are no quarterly reports, and there are definitely no dividend checks in the mail. The old playbook is just completely useless here.
And that's exactly why we need a totally new way of thinking. I mean, think about it. If you only value Tesla based on the number of cars it sells, it wouldn't make any sense. But Tesla is valued as way more than a car company. It's technology, it's AI, it's the future. Bitcoin is the same kind of deal. It's this unique blend of a scarce commodity, a tech protocol, and a global monetary network. So to even begin to understand its value, we need a brand new lens.
Okay, so if we're throwing out cash flows and profits, what are we left with? Well, Bitcoin's value is built on a completely different foundation. It rests on 3 really powerful, interconnected pillars.
Pillar number 1. Absolute mathematical scarcity. There will only ever be 21 million Bitcoin. That's it. That number is hard-coded into its very DNA. And no government, no company, no person can ever change it. This literally makes it the first truly finite digital thing in all of human history. And that scarcity, that is the absolute bedrock of its value.
Pillar number 2 is demand, right? If scarcity is the foundation, then demand is the engine that actually drives the price. As more and more people and companies, and now even governments, want to own it, more of that finite supply gets locked away for the long term. And when you have rising demand meeting an available supply that's always getting smaller, well, that puts some serious upward pressure on the price.
And this leads us to the third, and maybe the most important pillar of all, belief. At the end of the day, Bitcoin's price is just a reflection of what the market collectively believes about its future. Is it digital gold, a way to protect your wealth from inflation? Is it the groundwork for a whole new financial system? The price is the market's real-time answer to those questions. It's the sum total of global belief in that future.
So, if the value is really based on this mix of scarcity, demand, and belief, how do you translate that into an actual dollar amount? Well, while there's no single perfect model, analysts have come up with several frameworks to try and quantify these pretty abstract ideas.
We're going to look at 4 of the most popular ones. First, there's stock to flow, which is all about scarcity. Second, the network effect, which looks at user growth. Third, the cost of production, which kind of treats it like a commodity. And finally, the gold comparison, which frames it as a global store of value. Just think of them as 4 different lenses, each one showing us a different part of the overall picture.
First up is stock to flow, or S2F for short. This model directly connects Bitcoin's price to its programmed scarcity, which gets cut in half about every 4 years. For a while, this model was shockingly accurate, but it famously predicted a price of over $100,000 in 2021. And when that didn't happen, its reputation as a precise crystal ball kind of faded. Now it's seen more as a broad guide for long-term trends. Next, we've got the network effect, which is based on something called Metcalfe's law. It's the exact same principle that makes things like the internet or Facebook so valuable. A network's value grows exponentially as more people join it. So every new user, every new wallet, every new business that joins the Bitcoin network, they don't just add to its value, they multiply it.
Our third lens is the cost of production. This one treats Bitcoin a bit like a mined commodity, like gold or oil. See, it costs real money for massive amounts of electricity and powerful computers to create a new Bitcoin. Because of that, miners have a huge economic incentive not to sell their Bitcoin for less than it costs them to make, which creates a sort of economic price floor for the asset.
And you can actually see this play out over and over again. Historically, whenever Bitcoin's market price has dipped down near its production cost, like it did back in late 2022, it just hasn't stayed there for very long. That level tends to act as a really strong support zone because it becomes unprofitable for miners to sell, which takes a lot of selling pressure off the market.
And finally, we have the gold comparison model. This one is probably the most popular story out there, and it's the one that a lot of big institutions use. It frames Bitcoin as digital gold, and basically values it based on its potential to steal some of gold's market share as the world's go-to store of value outside of government control.
Now, to put that into perspective, the total value of all the gold in the entire world is estimated to be around 30 times trillion dollars. So the logic here is pretty simple. If Bitcoin, with all of its advantages in the digital age, manages to capture even a tiny fraction of that market, let's say just 10%, its valuation would be astronomically higher than it is today.
So, after going through all of that, which model is the right one? Well, the answer is none of them, at least not by itself. And that's not a weakness in the models, it's a fundamental truth about just how unique and multifaceted Bitcoin really is.
I mean, just think about it. Bitcoin is less than 2 decades old. We've had hundreds of years to figure out how to value stocks in gold. But more than that, Bitcoin just refuses to be put in a single box. Is it a scarce asset like gold? Yep. Is it a technology like the internet? For sure. A network like social media? Absolutely. It's all of these things at once, and each of those different faces needs its own lens to be valued properly.
And this all leads us to the ultimate takeaway here. Bitcoin's price isn't determined by profits or interest rates. It's set by a constantly shifting, global, 24/7 consensus among millions and millions of people about what its future role in the world is going to be. Its value is the real-time measurement of our collective belief in its scarcity, its network, and its future.
Which leaves us all with the final, ultimate question. Is this whole thing just a massive, speculative bubble that's destined to pop? Or are we witnessing the messy, chaotic, but maybe unstoppable emergence of a blueprint for a brand new financial world? That is the multi-trillion-dollar question the market is trying to answer every single second of every single day.